Thank you. Thank you so much, Shivangi. Hello, everyone. It's a pleasure to be here. And before I forget, let me wish everybody a very happy Women's Day in advance. I would like to start with a small video, and I'm hoping as people join, that'll give us a couple of minutes also as more people join in. Just let me know if you can see my screen after I share the video. Can you see it?
Yes, ma'am. I can see it. Okay. People can respond on the chat box if they are able to see or not see the video. Yes, we are getting yes in the majority, so I think we can proceed.
Great.
Yeah.
Hello, everyone. Thank you so much for coming to help us conduct this experiment today.
We were of different ages. We were made to stand in a line.
Now, I'm going to ask you a bunch of questions. If your answer is a yes, step forward. If it's a no, please step back. Here goes. Ready? Did you learn how to ride a bicycle before the age of 10? Did you learn music in school? Did you take any lessons in sports? And no, video games are not a sport, even if it has the word game in it. Did you learn how to iron your clothes while still in school? Take a step forward. If not, take a step back. If you can make tea or breakfast, not just for yourselves, please step forward. If not, take a step back.
In the beginning, I think the questions were more general. People were still going forward and backward. Questions like, it was funny to see the cooking question. There were a lot of men who went ahead and there were women who were going behind.
Do you usually make all the household bill payments yourself? Do you know the circle rate in your area? Do you know the price of gold today? Do you know the exact breakup of your salary?
As the questions unfolded, the stark difference came out visibly.
Do you know the details of the financial documents you're asked to sign? Have you bought a vehicle in your own name without consulting anybody? Have you bought insurance policies unassisted? Do you watch or follow the budget?
You think you're doing okay, but then you're like, okay, these are kind of important things that I don't look at.
Do you manage your own finances and earnings unassisted? Do you know how to invest in mutual funds? Do you know the difference between a mutual fund and an SIP? Do you make the investments for your family members or your spouse? Do you file your own income tax return? Now, everyone who's in front, could you please turn around and look behind you? Initially, when you guys started moving, there wasn't such a big gap. My question is, when did this gap start to occur?
The minute the questions became about managing money, the gap between men and women became very clear and evident.
Women handling certain responsibilities regarding their own life, which were always passed on to someone else in the family or the men.
There was a slight unfairness I realized at that time. But at that point, it seemed normal.
I was upset. I wanted to be at the front of the line. It's like, why don't I know this? Why am I not confident enough to say, yes, I am able to understand this?
It was quite an eye-opener for me because I always depended on the men of the family to take care of my investments and, plan my future.
I felt that obviously men are more into it than women. So eventually I did expect the gap to be there.
Over the years growing up, there were certain very traditionally masculine tropes that were assigned for him and certain traditionally feminine tropes that were assigned for me.
For women, it's practically debarred to learn to know and to focus on money.
I wish I had known from the beginning of my childhood and kind of thought about that I would be doing so much better.
Just actionable measures is what we want to really.
Right. So let's go to my presentation. How many of you have watched this video? People can just raise their hands. So large number of you have watched this video, and um, does it strike to you as unfair? Yes, no? You can just also unmute yourselves and say.
Yes, I think so, yes.
Yeah. So, when I saw this ad, this is by the way by Paytm a few years ago, I was stunned to see that so many women are still lagging behind men as far as the whole, financial management, money making, financial decisions are involved. If especially for me, because I come from a very Marwadi business family where money is regular dinner table discussion. Okay. But I later realized that unfortunately that's not the case in most families. In Indian culture, it is still forbidden to talk about money very openly. But think about it. Managing money is an essential life skill. Right? Now, parents teach their children how to cross the road, how to swim, how to cook. Schools teach us basic math, chemistry, even physics, but nobody really teaches us how to manage money. Most of us learn by way of trial and error. And especially as women by our nature, we are always so worried about the error parts that we tend to leave management of our money to the supposedly more knowledgeable people, people we trust, like our fathers, our husbands, our brothers. Now, don't get me wrong, there's nothing wrong about having someone else manage your money. But it would be so much better if that happened as a conscious choice rather than simply by default. So before we jump into the session, let me make a disclaimer. I'm not a certified financial investor advisor, and I'm not recommending any specific stocks or securities if they do come up in my talk. I'm simply here to share the lessons I have learned in managing my finances and the finances of my family over the last few decades. And in the process, I hope to give you all, especially the women participants, some actionable insights. And hopefully by the end of the session, I will have demystified some aspects of managing money and will have motivated those of you who don't actively do it to take the financial reins of your life in your own hands. I have set aside a few minutes at the end of the talk to take questions, but you can send them in the chat box as we go, and Shivangi will help me with them later. So these are the 5 aspects that I will cover in my talk today. Now, by themselves, each of these topics can be discussed and debated on for hours at end, but we don't really have that much time. So I'm only going to highlight on a few critical things, a few things which I believe are critical in each of them. Okay. The first is saving and budgeting. Now, my first lesson in personal finance was when I was around 7 years old. So my dad started this idea where if me and my siblings, we brushed our teeth in the night, he would distribute all the loose change from his wallet equally between us. And we would collect all this loose change as chilla, right? And we'd go and put it in our piggy banks. And when our piggy banks got full, he opened savings accounts for us at a local bank just within walking distance from our house. Now, we didn't collect a lot of money every day. It was just a few rupees. But the euphoria of breaking open that piggy bank, counting all the coins, and then proudly walking to the bank to deposit that money was a feeling unparalleled to any monetary achievement I've felt since then. And so what started off as a bribe to inculcate dental hygiene into us resulted into a lifelong lesson in savings, which I have continued to impart to my children as well. So, but no, I don't bribe them into brushing their teeth every night. What I do is every time they do get cash gifts from family, I insist they hope that they will learn the basic rules of savings, the 50-30-20 rule. Spend 50% on needs, basically food, rent, basic sustenance, 30% on wants, such as your vacations and shopping and gadgets and movies, and save the rest 20%. If you want to save more, then you should be willing to reduce your wants to as little as possible and move that money to the savings. Right? But I realize a challenge in today's material world. With the ability to transfer money at the hit of a button, it's so easy to spend impulsively. But so that is why it is really essential to plan your outflows before the money hits your bank account. Divvying up your salary into these three buckets of needs, wants, and saving will help you earmark funds to save before you actually start spending them. Another thing to remember is, your recurring expenses, like your monthly expenses of commuting, travel, rent, food, etc. These are recurring expenses. Try and spend them from the income, the money that you make every month, and not from your savings. Okay. If you get one-time inflows like your bonuses or gifts or whatever, try to use them towards one-time payments, such as prepaying your loans, making big value purchases, or if you don't have anything in mind, simply add that entire chunk to your long-term investments. Planning your money before it comes into your bank account is a great way of ensuring you have good control over both your spending, budgeting, and saving. Now, budgeting is also very important, especially from a goals perspective. If you plan for specific goals, that's a great way of determining how much money you need to save and where you can invest it. Like you can see in this table on the right, right? How you can, the thumb rule is essentially 50, 30, 20. But when you determine your goals, you also need to identify where you're going to save them. Okay. All the savings, if you look at this table over here, all the savings for the short terms are invested in debt because you don't want to take the risk of losing your capital for short-term goals where you're going to need the money immediately. You don't want to earn a lot of money, but you also don't want to risk your capital. And typically you would put it in short-term securities or low-risk options, right? But when you want to take a high risk, you can do that with long-term savings because you have a really long term to make up for any temporary dips, right? And so you might want to then choose to save the long-term savings in longer-term investment options, right? Now, this entire aspect of should you save in short-term securities, should you save in long-term securities is called allocation. So you'll keep hearing about asset allocation. Asset allocation is simply where are you going to save money, in which bucket, in which basket, right? Whether it's going to be short-term, long-term, debt, equity, etc. Now, you also hear this thumb rule, which says that invest as much percent equity as is 100 minus your age. So if you're 30 years old, you will be advised to save 70% of your savings in longer term, higher risk investments such as equities, and 30%, which is your age, in safer avenues such as debts and mutual funds, which are based on debt or fixed deposits. Now, well, generally this is a good advice. Don't follow it blindly. First, determine your goals and then identify savings to match these goals, right? If you look at this table again on the right, I've prepared this assuming somebody who's young, let's say 25 years old, and wants to get married in the next few years and also build an emergency fund and wants to buy a two-wheeler. Now, if you look at the breakup, you'll see that 60% of her savings are in actually debt options and only 40% are in equity. But if you follow the asset allocation, which is 100 minus your age blindly, you will go wrong. Okay. And so while this is good advice in general, don't follow it blindly, use some discretion. When you're doing asset allocation, you also need to understand inflation and risk. Okay. Now, you don't need to know very many details, but basic idea about what's inflation and what's risk will help you figure out good investment securities, evaluate them yourself. So average inflation in India over the last decade was about 6%, a little over 6%, which means that your money today is worth 6% less than it did last year. So to beat inflation, your average returns on the investment you make should be over 6%, right? If your investment returns, if your investment yields more than 6%, then you have beaten inflation. But if you really want to grow your wealth, then the returns on your investment should be considerably higher than 6%. 6% is not going to cut it. You're barely going to keep up with inflation. Now, so let's look at risk and return a little bit more. Okay? This is a chart that gives you indicative pre-tax returns and the corresponding risk on the scale of 0 to 10. So the risk is on the x-axis and the returns are on the y-axis. 0 being the lowest risk and 10 being the highest. Now, just let's keep aside PF and PPF for a minute, but look at the other investment options. The returns on these investments goes up as the risk increases. Okay, the potential return, and again, this is all pre-tax return. These are indicative returns. If you hold a gun to my head, I will not accept these necessarily, but these are just indicative returns that I have seen. Okay, now India, again, like I said, we already had an inflation of about 6%. Now, so if you see the average pre-tax return of savings accounts, fixed deposits, real estate, gold, corporate FDs is just about 6% or lower. So had you saved your money in any of these options over the last decade, the value of your assets has not kept up with inflation. In fact, your money is worth less than it was a decade ago in real terms. Okay? And you realize as the risk you take goes up, your chances of beating inflation and actually growing your wealth also goes up. Okay, the highest returns being in something like stock options or investment startups or the likes, but these are really, really high risk investments. And if you know, you've heard of statistics which say that 1 in every 10 startups fail. Your money in these options can just as well, it can return you 25% plus on an annual basis, but it can just as well tank and wipe out your entire capital as well. So does that mean that you should not invest in startups or not opt for ESOP, or does that mean that you should not invest in fixed deposits or gold? No, I'm not saying that. Okay. Risk is good. Okay. Calculated risk is even better. A few things you need to remember is in the short run, you want to minimize the risk to your capital, but in the long run, you want to maximize returns. And so again, if you want to make a big purchase in the short period, or if you're accumulating money, you're saving money for a short-term goal, like you want to upgrade your phone, or you want to go on a vacation in the, after 6 months, then you're better off keeping money in a safe instrument like a liquid mutual fund, a fixed deposit. But if you're saving for retirement, and let's suppose you're 30 years old, then you can afford to save in a higher risk instrument such as a mutual fund or equity shares, because even if there is a temporary tank in or dip in the returns, over the period of 20-30 years, you'll still make reasonably good amount of money. Okay, so in conclusion, when you're reading this chart, where you invest your money, it really depends upon the timelines of your goals and the ability to take your risk. The idea of asset allocation is how you balance your risk and returns between all these options, such that you not only beat inflation, but you also grow your wealth over a longer term. Now, you'll ask me, sure, all of this is fine, but how do I invest and how do I pick these things, and what's a good ratio to hold them in, right? So let's talk about that a little. Now, and I'm sure you've also experienced this. Whenever you ask someone for investing advice, the most common answer you will get is start immediately, start now, start early, or some such variation of it. And this is great advice. Okay, you can start investing early. It gives you a fantastic advantage because you can save more. But I mean, come on, we already know this at some level, right? We know that we should start saving early. But despite knowing that, only a handful of people actually invest. There's a difference between saving and investing. Okay. And in my experience, why only a handful of people actually do active investing is because they simply don't know where to start. And this is more so with women. You'll find so many, and I'm guessing I wouldn't want to take a poll in the participants right now, but just ask yourself how many of you have left excess money in your savings account because you don't know where to put it, right? Savings account is going to return 3% interest to you, not beating inflation. You're losing money by doing that. Okay. And as a beginner today, you can invest in pretty much all asset classes from the comfort of your home. You can invest in stocks, in exchange trading funds or ETFs or bonds. You can, there are thousands of mutual fund schemes with all sorts of regular, direct, growth, dividend plans. There are hundreds of insurance plans with all types of combinations, riders, add-ons, exclusions, guarantees, inclusions, top-ups. And then there are innumerable bank relationship managers and insurance agents, all of who are trying to sell you all sorts of products. Now, for a beginner, these abundant choices and the whole noise around them, because may lead to decision paralysis, because digesting so much information is quite a nightmare. And so, because of this overwhelming choice that all of us get, sometimes we tend to, that tends to drive us into inaction because we're just so afraid of making the wrong decision. And this is the biggest reason why so many, and especially women, do nothing to keep their, and just do nothing and just keep their money in the savings account. Or they'll go and ask friends for tips, or they will listen to the banking relationship manager, or easiest, simply hand over the money, monetary reins to the male members of the family. They're doing investments for themselves. You might as well do this for me, is a lot of times what I've heard being said. Okay. Now, trust me, you don't need a PhD in finance or to be a chartered accountant to invest in these 4 securities. As a beginner, when I started off, I just used these 4 options for investing until the time I became a more confident investor and could wade into deeper investment waters. Okay. So the first one is mutual funds. Most people think picking a mutual fund is very important. Let me assure you, what matters at the end of the day is whether you have enough money for goals. Okay. Studies have shown that in the long run, even professional money managers aren't able to constantly beat the market. So don't worry about picking the best funds, or timing the market, or beating the market, or earning extraordinary returns. You can get reasonably good returns of around 12% by investing for the long term in any index linked fund or ETFs. Okay, just go to a website, any of these websites, Money Control or Economic Times, or if you invest through ICICI Direct or Zerodha, whatever, and pick a couple of top rated funds with low expense ratios. These are the only things you need to really see. Which are the top rated funds, and they will be top rated because they've yielded good returns over the last 1 to 5 years. And with the expense ratio, the low expense ratio, the higher money you get. And simply set up an SIP. An SIP is a systematic investment plan. You can decide how many units you want to buy, or you can decide how much money you want to invest on a monthly, quarterly, annual basis, and just set up automatically. Okay, because what matters in investment is consistency. Consistency is more important than trying to pick mutual funds. Now you realize that most of your investment advisors or bank relationship managers will not push this product because they have very low expense ratio. They don't make very much money. Banks or investment funds do not make very much money, and so it's not in their interest to sell these products to you. So you will have to put in a little bit effort to go look these up and invest in them. Okay. Opting for an automatic SIP as soon as your salary is credited is a great way of ensuring that your savings happen before you start spending for the month. So if your salary is credited on 5th of the month, set up your SIP for 6th. So automatically whatever remains in your bank account, subject to emergency funds, only that much can be used for expenditure. It'll help you save more. Okay. The next option is PF or PPF, Public Provident Fund. This is among the best investment schemes that you can find in India today. You get around 8.5% of post-tax returns. Okay. And not only is the interest on PF exempt from tax, you also get a deduction from your income tax for all the money that you put into your PF accounts. Just to say, just to tell you how it can be used, you can use this for your children's education, for your retirement savings, for any goal that will come up beyond 15 years, because that's the maturity period of PPF. PF, of course, this is deducted by your employer. You can also choose to tell your employer, if you don't deduct the minimum balance for me, you can increase my contribution to whatever you guys want. Okay. Currently, employers will only deduct around 1,800 rupees, which is the maximum they are required to. But you want to contribute more, you can go ahead and do it. The only flip side in PPF or PF is the long maturity period. So use it carefully. Like, for example, the way I use it is when my children were 2 or 3 years old, I opened their PPF accounts at a local bank. And every year, all the cash gifts that they get, which they're supposed to spend, plus a fixed amount every month, I deposit into their accounts. I get income tax benefit, and that's a forced saving. After 15 years, when they turn 18, which is when the PF account will mature, at 18, they will be ready for college, and my PPF account will have matured, and they will have a huge chunk of money in their account, which can be used immediately to pay for their tuition fees or expenses for an undergraduate degree. Now, if you don't have children, PPF or PF is also an excellent option for your own retirement savings as well. NPS is the third one. This is also very popular and has become popular lately, but I'm not a big fan because I don't like investments which are tied, which I have, which I have to be tied to for a very long time. The way NPS works is you have to contribute. Once you start NPS, you have to contribute to it until you turn 60. Irrespective of whether you're employed or not, whether you're working or not, you have to contribute. And you can withdraw the money from NPS only after you cross 60 years of age. So if you want to take an early retirement, it does not work for you. Okay, you have to sort of wait until you're 60 to touch the money over there. And even when you turn 60, only 40%, you can withdraw only 60%, and 40% of that balance has to be compulsorily converted into an annuity, which means that they'll keep 40% of the balance, and every month they'll give you some small amount. And you will never get that 40% back. You'll only get it back in small amounts till the time you're alive. This is not a very great annuity because it barely turns around 5%. So it's not going to even beat inflation. It's not going to count for a really large amount if your corpus is not great. But again, if you don't want to figure out investments and mutual funds, and you are an impulsive spender, then go for NPS. It's a good option for those who don't want to actively do investments. And anyways, if you're planning to retire at 60, it might still work for you. For others, I would only recommend investing up to 50,000 rupees a year just to get that additional tax benefit. Okay. The last is fixed deposits, mutual fund, liquid mutual funds, your NSC, etc. These options will return anywhere between 5% to 7% pre-tax. not great investment vehicles, but they're okay to park funds for the short term or keep money for emergencies. A lot of banks also have overnight sweep facility where the funds in your savings account can be transferred into overnight debt instruments with a slightly higher return. So instead of parking your money only the savings account, the bank will take it out overnight, put it in a mutual fund, and then in the morning return it back to your account. And for that 24 hours or 12 hours that it stayed in an overnight fund, you'll get some additional income. It's not great. Maybe you'll get 1%, 1.5% more, but it's just money sitting in your account. You're not doing anything with it. So anything over the regular savings interest account is anytime good for you, right? So I figured that these 4 options are good enough for most beginners. Okay. If you are able to distribute your savings into these 4, you are good. You're better than most investors out there. But if you do have time to do research and you have the inclination to learn about the intricacies of the stock market, you can also directly invest in equity shares as well. Just remember that direct equity investment can be a little exciting. Okay, it's because direct equities can be quite volatile. So if you're a beginner, limit your exposure to direct equity only to the extent that you're able to handle large fluctuation. Don't invest the funds that you need in the short term in direct equities. Like an overnight unanticipated drop in the stock market is good enough to wipe out the growth you've achieved over some few months. Like if you look at the current performance of the equity market right now, it's a case in point where earnings of the last 6 months have been completely wiped out in a matter of 8 to 10 days because of the ongoing Ukrainian crisis, right? So if you had put money in the stocks around in September or beginning of October, you will realize that there has been no growth, and that's simply because in the last 1 week stock markets have tanked. And if you had put that money into equity, for assuming that after 6 months you'll take it out and spend it on something, you'll realize that it's the same amount and you've not made any extra money. Hopefully you will not have lost capital. And so I'm keeping on saying, any short-term goals, move it out of equity, keep it in debt, so at least your capital remains. Okay. Now the third one, which is the boomer generation, and it's me and my parents probably as well, right? We're the boomer generations. And this is also an opinion which I have, which is a contrarian view. If you look at the older generation, buying a house was always equal, it was always equated to being stable in life. So house always equal to stability. And so many of you, as soon as you start earning a reasonably high salary, you will notice that your parents or the elder people in your family will start advising you to buy a house. Okay, I have a completely different view on this. I believe you should buy a house only if you can afford it. My advice to most people is don't buy into the misguided notion of family members about creating an asset or getting stability or laying down roots until and unless you are ready for it. See, given that more and more people are moving out of their hometowns, all of us are hopping from city to city for jobs, houses are no longer an investment, they are actually expenses. And so don't rush into buying houses. Also, don't buy houses for tax savings. It is not worth it anymore. You will in fact save more tax by claiming HRA deduction on the rent that you pay. Okay. Then you will on the EMI payments. Consider this. According to the current income tax rules, the maximum deduction you get for buying a house on loan is up to 2 lakhs of interest and up to 1.5 lakhs for repayment of the principal. So that's about 3.5 lakhs per year is the maximum deduction. So optimum loan amount comes to around 40 lakhs. if you want to take full benefit of the EMI you pay. But just think about it. When was the last time you could buy a 2 BHK in a metro, in a decent locality, in a central location close to your offices, close to schools, etc.? When could you buy it in like 50 lakhs? Right? You can't anymore. If you want a 2-bedroom apartment in a city like a metro city like like the NCR region, Bangalore, Mumbai, you will need to spend at least 70 lakhs to a crore, which means borrowing of between 50 lakhs to 80 lakhs. That's a minimum borrowing, which means an EMI of 50,000 to 80,000 rupees a month. So if half of the EMI you are going to pay is not going to get you any tax benefit, what's the point of buying a house to save taxes? Okay, there isn't. So again, I reiterate, buy a house only when you're ready for it, when you can afford it, when you want to actually settle down in a place. Do not get into this house buying thing before you're ready. Okay. The next investment option traditionally used is gold. Now, historically, if you look at it, gold has returned between 5 to 6%. Okay, at least in the last decade, it has. Pre-tax, lower than current inflation. So again, not a great option. But if you're a girl child, I'm sure your parents would have bought a ton of gold for you in preparation of your marriage. And so if the value of such gold is between 5 to 10% of your overall savings, you don't need to buy any more gold. But if you are tempted and you do want to buy gold, then look at options such as DigiGold, where you invest in securities backed by gold. Whenever you need, you can return that security, that certificate, and the bank will return you gold in exchange. Okay? Or you can invest it in a sovereign gold bond. They're safer since you don't have to worry about getting a locker or a safe deposit box in a bank. You don't have to worry about safety, none of that, and it will appreciate in the same manner as that of actual physical gold. Okay, so go for gold. Good to have in your portfolio, but not that much. It'll help you because it's stable, it's backed by an asset. You want to use it to convert into jewelry, you can do it very easily. Okay. Now the last one option is for high risk takers. Okay, and there's a huge buzz around these currently. If you are young and you are working in a well-to-do startup, I would really urge you to consider taking a large portion of your salary in the form of stock options. If your startup is doing well, the gains on the appreciation of ESOP can be significant. But options like angel investing or P2P lending, you have excess money, you want to go to lending cart and you want to give money to strangers at 18%, sure, go for it. But do realize that these are very, very high risk options. They will also reward you with handsome returns, but you have to be aware of the risk, okay? Because it can actually, these options have the ability to wipe out your capital as well. Crypto, NFT, all new, not yet recognized in India as valid. Crypto is not recognized as a valid currency at all. Sure, you could treat it as an asset class, you can buy, but remember, cryptocurrencies also come with ongoing recurring expenses of the wallet, subscriptions, those kind of things. And again, there's a lot of uncertainty in India, so you might want to decide whether you want to take chance with it or not. Okay, but certainly, if you have age on your side, if you're young, if you have the ability to take high risk, or if you have a good understanding of how these options work, and so you can take calculated decisions, go for it. Only put that money into these options which you can afford to lose. Right? If it comes to zero and you can still go on without any worries, then these options you should try. Else, if you're a beginner, go for the first 4. You'll be good. Figure it out over the next few years and then get into larger, riskier options. Okay. This is as far as the investment, high risk or risky investment goes. Now, what are the other things that you need to worry about when it comes to personal financial management? Loans or debt. Okay. Now, most people like me with middle class upbringing have always been deterred from borrowing money. We have always been conditioned to believe that all debt is bad. You should not take loans, you should not borrow money. I don't believe that's right anymore. Okay, sure, there are certain kinds of debt that one should avoid, but it's not necessary that all debt is bad. Credit card debts, yes, most people don't realize that the interest on credit cards can be as high as 20% to 40%, okay, per annum. And so when you use credit cards, use it only for the convenience they bring to you, and to the extent that you can repay. Don't use them to fund expenses you cannot afford. Credit card debt trap is very easy to get into, and it is very difficult to get out of. So if you are an impulsive, excessive spender, my advice to you would be, please don't get credit cards at all. Okay. Personal loans. I see so many people taking personal loans for discretionary expenditures such as vacations, weddings, etc. Think long and hard if these expenses are really worth borrowing money at exorbitant rates such as 13, 14, 15% per annum. Essentially, if your personal loan period is 5 years, you are going to pay twice the amount of money that you borrowed over those 5 years. So a vacation might cost you 1 lakh today in terms of a loan, but the actual cost to you when you repay that loan will be 2 lakhs. Is it really worth it? Think about it long and hard. If you still believe, yes, that's what you want to do, go ahead. But then don't try taking personal loans. Try borrowing against assets. You have a PF balance, you might have some savings, you might have mutual funds, you might have some gold. Offer that as a collateral to the bank and get a loan against assets. Your interest payout will be much lower. It will be around the tune of 10 to 11%. And that's basically a 30% saving in interest. So do that. Now, moving on, if you do choose to buy a house, being a female has excellent advantages. Okay, you might get subsidized interest rates. Most nationalized banks these days offer between 0.25 to 0.5% subsidy on interest if they are lending to a female borrower. You might also be able to avail of lower stamp duty, lower registration fees on buying properties in certain localities. Also, it makes sense to be a co-borrower with your family member, with your spouse, whichever family member you're buying the property with, because then both of you can claim tax deductions. Whoever makes a payment towards the loan can get tax deductions. So you can just double the benefit as well, the tax benefit as well. For women, again, education loans are a great way of funding yourself for higher education. In India, 100% of the interest that's paid on loan is deductible against your income. So any interest that you pay on your education, you can offset it against the salary you earn post you're getting your degree. Okay, which basically makes the post-tax interest cost of that loan very reasonable. Today, you will get a loan between 8 to 9%. And once you start repaying it and you start earning salary, you will get between 25 to 30% tax benefit. So your interest cost on that loan is going to be as low as 5 to 6%. So it's an excellent way of funding yourself. And so long as you are enrolling in a good professional degree in an accredited college or university, based on grade, and you don't have to worry about getting a job after the degree, that's again a great get to have. Okay? So in conclusion, loans themselves not bad, but excessive borrowing is. Borrowing for short term, borrowing for discretionary expenditure, typically I don't advise. Try to save for such expenses and goals, okay? And then what happens, and then you're spending only what you can afford. You're not spending what you cannot afford. You're not funding it by loans, so then you don't have to worry about a debt trap. Okay. Lastly, keep a watch on your CIBIL score. CIBIL, so this website, you can go and download your report, CIBIL report, free of cost once every year. Do that. Irrespective of whether you need it or not, go download your CIBIL report. It's very interesting. It'll give you details of all your borrowings, all your credit cards, etc. And you'll come to know if there are any open credit cards out there in your name. I don't know if you guys have been following news, you would have realized the erstwhile India Bulls has been giving out loans to all sorts of random people using KYC documents of, again, all sorts of random people, and people who are downloading their CIBIL reports have been realizing that other people have taken loans on the basis of their PAN cards and all. Just to be safe and just to ensure that nobody else is doing it for you, just go ahead and download that report. Okay, a good so a CIBIL report will give you your credit score. A good credit score indicates responsible financial management. And if you have a high CIBIL score, a credit rating score, then you will also be able to get better interest rates on any borrowings, any loans you want to take from NBFCs or banks. Okay. The fourth pillar of management, and especially this is a lesson that the COVID pandemic has taught us, right? That life is fleeting. My guess is that most of us were probably unfortunate to lose a young, fit friend or family member last year due to COVID. Okay. Which is why planning for contingencies is very important. And women especially are highly vulnerable when it comes to contingencies, and so you have to be prepared for that at any point in time. The first thing you need to be ready for is insurance. Okay, one thing that can cripple you is a trip to the hospital. Cripple you monetarily, I mean, is a trip to the hospital. A single hospitalization can, has the potential to wipe out years of saving. And in some cases, it can actually push people into debt traps as well. Okay. If your employer already offers you a health insurance plan, and I'm guessing you're here because PasCare is the insurance partner, you already have a head start. Okay, but women especially should check if the employer's health policy includes maternity benefit, postnatal care, neonatal care, etc. If it does not and it's important to you, please go get yourself a top-up. If you think that the plan is good enough to cover all exigencies, great. If you don't think that's the case, you also can consider buying an additional health plan for you and your family. Okay, getting medical insurance as early as possible is beneficial since the premiums are low, and if you start early, there are less exclusions as you go along. Now, life insurance you will only need if you have debt or you have dependents. You don't need life insurance otherwise. Traditionally, women were, never in India, never encouraged to get life insurance because they did not contribute much to the family's finances. But this is changing now. And so when you do get life insurance for yourself, remember to buy only a term insurance policy. A term policy pays out only in case of your death. You don't get that money back. Otherwise, it's an expense. You'll be tempted by a lot of these bank relationship managers, or also don't be swindled by these neighborhood friendly LIC uncles, they might trap you into buying endowment policies or guaranteed return policies, those kind of things. And these policies are not great. They don't give you very good returns. Even if they do give you money back, it's not great returns. And they're only designed to benefit insurance agents because they get a huge amount of commission. And so the best thing to do would be to buy a term insurance policy. It is much less expensive, and don't worry about getting any money back. Treat it as an expense, let it go. Okay. A thumb rule, how much insurance you should get is typically either it should be enough to cover the debt you've accumulated, the loans, or it should be around 10%, 10x, 10 times your annual income. But one thing that most of us forget to do is after we get life insurance, we forget to top it up. So today, let's suppose your income was 8 lakh rupees a year and you got 10 times insurance, which is 80 lakhs. 5 years from now, if you are married, if you have children and your income has gone to 20 lakhs a year, you should remember to increase the term insurance to 2 crores, because at that point, getting a return, something happens, unfortunate event happens and you die, and getting only 80 lakhs back may not be sufficient for your family to continue living the same kind of lifestyle that you're used to when you start earning 20 lakhs, right? So remember to top up your life insurance also, so that the payout on your death is actually meaningful. It's substantial enough to actually count for something. Okay. One thing I cannot emphasize enough, and again for women very, very important, is understand the process of claiming insurance in advance. Okay, because typically you will need to use insurance only in an emergency. During an emergency, you won't have the time or the mind space to untangle that red tape or read fine print or terms and conditions of those insurance policies. So when you're buying insurance itself, completely try to understand what is the process of claiming that insurance that you'll have to go through at a later stage. At least being aware of it will help you a lot in dealing with the emergency. Okay. Another way of dealing with emergencies is by setting aside an emergency fund. Now, again, the ballpark, the thumb rule over here is set aside 3 to 6 months of expenses. Keep it in a place or in funds which are readily accessible, which is just leaving them in a savings account or doing a short-term fixed deposit or keeping a liquid mutual fund, which you can withdraw within 24 hours. That's a good enough thing. You won't get a lot of returns, but at least that money will be immediately available for use. Obviously, the 3 to 6 times of your monthly expenses is a general guideline, and it may differ. The quantum may differ for different people, especially contingent on your stage in life. If you're single, you can get by without very much. If you're a married person with dependents, then the quantum can be much more. And if you or your dependents are not covered by medical insurance, and in my experience, most emergencies are of medical in nature, then you might want to keep aside a higher emergency fund. Whatever it is that you decide to keep, make sure that your close family and friends know about it. They know how to access that fund in case the emergency is about you. Okay, so that's very important. Not only should you make the fund, but you should also tell people around you what. Okay. Right. And so this is the last aspect of personal financial management that I would urge most women to really think about. Okay, retirement and succession. Now, most of you are probably very young and you have a lot of near-term goals, such as funding your higher education, buying a car, saving for your wedding, buying a house, or if you have children, saving for their education, etc. And retirement might seem like a really far away. Okay, used to be that our parents would retire at 60 and they would save enough money to last them for 10, 15 years. and then they would depend on their children to look after them in their old age. But things are different now. We don't live with our parents anymore. Children don't live with us anymore, right? And so many of us don't even live in the same cities as our parents. And with people like us retiring at early age, we have excellent medical facilities now. The average lifespan has gone up. So while our parents could retire at 60 and then live up to 75 and would have enough money to take care of themselves until 75, we are going to have a longer lifespan. And so we are going to have a longer retirement life of between 20 to 25 years, which is almost as much as, the number of years we are going to earn and save money. So this basically means that you really need to start saving for your retirement as early as possible. Just to give you an idea of the impact early savings can make on your retirement corpus. If you want to retire at 55 today and you want a corpus of 3 crores, if you start at the age of 25, you will need to set aside 9,000 rupees a month. Okay, put it in an index fund or an ETF, and you will get about 3 crores by the time you're 55. But if you start 10 years later, if you start at the age of 35, you will need to set aside 31,000 rupees per month instead of 9,000 rupees. Okay, that is the power of compounding, and that is why it's never too early to start saving. Okay, this last part about making a will, again, used to be that people made wills after they retired in their later stages of life, where people would start thinking about, death and succession and things like that. But given the uncertainty in life, it's best to make the will as soon as you start accumulating assets, especially if you have dependents, right? Spouse, parents, children. A will is a legal document. It will lay down what happens to your assets in case of your death. Especially for women, very essential, extremely essential, and especially because the inheritance laws in India today are not gender neutral. Okay, the inheritance laws which apply to men do not necessarily apply to women. In fact, if you look at the Hindu Succession Act, it has 2 very strange provisions which most women are not aware of. If a female Hindu dies interstate, which is basically without making a will, and she does not have children, then the property that she has inherited from her father or her mother, it goes back to her father. It will not go to her husband. It will not go to her mother, even if the mother has gifted it to her. It will all go back to her father and her father's heirs only. That's what the law says. Okay. If you are married and if you don't have children, all the property that you have acquired during your lifetime through your own earnings and your own savings will go to your husband. If your husband predeceases you, if your husband is not alive, then all the property that you acquired will automatically go to your husband's heirs, which is your father-in-law or his children. Okay, the woman's paternal or maternal family cannot inherit her property unless and until it is explicitly written down in a will. So if you are a Hindu female and you want to bequeath your personal assets to people of your choice, then it is absolutely essential for you to make a will, because if you don't, the law will take its own course and the property that you have inherited or earned or bought yourself may end up in the hands of people who you did not have any intentions of bequeathing it to. Okay, so to make a will, until the time you make a will, please follow these three tips that I've given you. That will help you, your family members, also tracking your assets. Okay. There's a list of do's and don'ts. I'm just going to have a sip of water and give you a minute to go through them, and then we will close. Right. Okay. In closing, if you are a single woman, either by choice or by circumstance, you need to create a roadmap which ensures your financial independence. If you are married, you must actively participate in the financial plan of your family, because whether or not you contribute to the finances, you stand to be affected as a beneficiary. And I hope in this talk, I have convinced you that managing your personal finance is not complicated at all. My talk has not covered all aspects of managing personal money, but that's not the point, because you can either waste precious time being uncertain and not doing anything, or you can at least get started with these aspects, which will cover about 70 to 80% of the things that you really need, and figure out other stuff as you go. So thank you for listening to me patiently, and I wish you all the best as you set off on the journey of your financial freedom. If there is time and if you have questions, I will let Shivangi
Yeah.
take them.
I have one thing, ma'am. Like you have explained everything so well, but one thing that that you can say that you should start doing it from today onwards for saving purposes. What is that one thing?
The one thing that you should start doing right away is get medical insurance and to build an emergency fund. Once you have these two, then you can start actually saving.
Okay. So I have seen Manisha raising her hand. Go ahead, Manisha, unmute yourself and you can ask.
Yeah, hello ma'am. Thank you so much for like conducting and explaining all these points in detail. So I just have a very particular doubt to ask. That is, suppose you get your salary credited at the month end or first week and you're planning some expense, but you don't know when exactly is the date, maybe after 30 or 45 days. So
Yeah.
for that time period, like for 20 to 40 days, where should you park your money so that you don't lose out the initial this thing and get something more above your savings bank, say around 3 to 4% at least. So what is the safest this thing and easier way also, like which we can be done online?
Yeah, yeah. No, that's a very valid question, Manisha. See, what happens in a savings account and a regular savings account, you anyways get between 2.5 to 3% interest on the balance. Okay. If you look at the fixed deposit rates of large banks such as HDFC or Axis Bank, they will give you up to 3.5% over 60 days. Under 60 days, they're anyways going to pay you 3% only. Okay. So for a very short time of 30 days or 45 days, moving money into a fixed deposit, moving it back is fine if you have online access and you can do it very easily. If not, you can also look at liquid funds of 30, 45 days, but the interest is not going to be that much more different. It'll be in the ballpark of 3.5% itself. So you figure out whether the entire process of investing, taking it out is worth it for that additional 0.5%. If it is, and it's not difficult, you can do it online, go for it.
Okay, sure. Thank you. Thank you so much for this
Sure.
advice.
Yeah, I don't think so. We have any more questions because of the very detailed session, I must say, ma'am. So I think all the queries have been resolved in the session itself. So
Okay.
even if people have, yeah, even if people can have, they can ping us, and we will obviously take it forward to Sujata, ma'am. A very great session, ma'am. Like I just got some very new perspectives.
Thanks, Shivangi, and I hope it was as useful to the other participants also. Thank you so much.
Yes, ma'am. We are getting very good reviews. Like everyone is thanking you. So,
right. Thank you, guys, and wish you all the best.
yes, same.
Okay.
Okay, bye everyone. Thank you for joining us, and you can look forward at our Luma Pascale wellness session. We are coming up with more sessions. So over to you, Anshik. Do you want to add something?
No, thank you so much, Sujata ma'am, for being a very great orator here, and
Yes, definitely.
explaining everything in very detailed way. So you'll be from our side, you'll be getting one feedback mail from our side very shortly. So just put in your feedback, and we would be really looking forward to it. And we'll be conducting more women oriented session shortly. So we have one more in our pipeline, and look forward to seeing you there. Thank you so much, everyone.
Thank you so much. Thank you so much,
Thank you.
Sujata ma'am.
Bye-bye.
Thank you. Bye.